comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Welcome back to another episode of Final Settlement. Today is Monday, July 14th. I'm joined, as always, by my co-hosts, Liam Nelson, Michael Tanguma. Michael, you were just saying the worst part about new all-time highs is what? As Bitcoin crosses 121, I think it hit 123 earlier this morning. But what's the worst part about all-time highs, Mike?
I think if you're outside the industry, it's fun to sit back, but when you're in the middle of it, there's just so much going on that there's just a lot of stress and anxiety. And I genuinely appreciate when the awareness from the world isn't on this asset class. So that's what I was referring to. I will also share that I feel a little bad for Jackson because we had the great BPI rip early in the week. So we kind of missed a lot of this all-time high, and Jackson was really hurting because he loves to just talk about price. And so we almost did an emergency pod on Friday. We didn't. And then we got to record first to talk about what the hell is happening in Bitcoin. I think like overnight, maybe got up to close to 123. Is that right?
Yeah, I think 123, a little over 123 on some exchanges is what I saw. But yeah, to last week, I think we had recorded, as you mentioned earlier in the week, and then we were kind of just watching the price on Thursday, being like, should we do an emergency pod? And Jackson had put the level out there of 115. And it eventually did cross 115 that evening, but it was already a little late in the evening to jump on an emergency pod. So we get the honor of speaking to new all-time highs. We're at 121.7 right now. What do we think's happening here, boys? Any notable catalysts? I think partly some people are trying to attribute this to some words and thoughts and rumors around Powell either resigning or having necessary cause to fire him. That could be part of this. As I like to say, this is just more buyers than sellers. If you just want to boil it down to sellers getting exhausted at these levels, which we've been talking about for weeks, sort of the coiled spring, which I actually wrote about in last week's newsletter that came out around noon on Thursday, right before it kind of started taking off. So some prescient commentary there, but any thoughts around what could be driving this?
Yeah, I think it's the same as always. It's just price goes up, it educates more people in the market, and there's a ton of new vehicles to get exposure, whether it's the ETFs, which we're going to go into, all the new treasury companies, there's options on the ETFs. And so everybody's kind of been seeing this arbitrage strategy, both on the publicly traded company side, as well as just, the good old arbitrage strategy of buying Bitcoin, waiting until the price goes up. And, some people end up selling at, price X, Y, and Z. But really, the big arbitrage strategy is just Bitcoin has only some amount of units, and dollars and fiat is, not constrained by any math or anything. And so people are just being more educated on what Bitcoin is, the different vehicles out there. They're educating the rest of their teams, if they are on an investment team or whatever else it is, on the value proposition, either, if they're completely neutral to Bitcoin or if they want to be long the asset class. And it's just bringing in more liquidity, which brings in more liquidity. And the two big value drivers of Bitcoin are its ability to transact and store value throughout time. And it only gets better at storing value and transacting as more liquidity comes into the asset class. So it's doing a fantastic job.
Doing a fantastic job at storing value right now. Mike, any thoughts?
Yeah, I think there's a confluence of things happening. One is naturally like more buyers and sellers. We chewed through the $100,000 kind of 110, just like price point. I think we kind of maybe missed the mark there. A lot of individuals thought 100K was that price point. I think long term, it'll be that price point to show people it can get to $1 million. But in the short term, there was a lot of downward pressure from OGs and people just needing to sell. I think there's something completely outside of Bitcoin, which is just what Brian referred to as like more the macro landscape, whether it's almost everything at all-time highs in the public markets coupled with what's happening with PAL. I think what's interesting about this time is we've already seen Bitcoin behave as like a true risk-off asset, or I don't want to say true risk-off, but it has been super it's been resilient and off the face of like what happened with the tariffs in Iran. Like, so we've kind of seen glimpses of, it can play in both directions, but I think right now the direction is risk on. And then, yeah, of course, the Pubco stuff is a lot of downward pressure. The thing that's the most interesting for me, or upward pressure, the thing that's most interesting to me is there's no retail. Like, and I don't know if it's a mix because retail's eating up the Pubco stuff. I don't think that's the case because it's just nobody's talking about Bitcoin. Like, it's very outside of the traditional Squawk Box, CNBC, and a couple of the corners. Like, nobody cares that the Bitcoin price is $123,000, and it's fascinating. And I don't know what, like, if it's FTX just kind of like pushed everyone. It's like, screw it, this thing's all a Ponzi, or if it feels like there's something that happened between 22 and 25 that has put people's like blinders on to certain like mimetic. I don't know. There's something here right now that is going to take a while before the masses really come back. And I'm not really sure what it is yet, but it's going to be exciting. It's going to come out of left field probably.
I think that's definitely true, but I do think that there's a caveat there of like a lot of the ETF flows over the past 12 months have been what you would typically call like a retail buyer that's just buying the ETF through their brokerage account. And so I think retail just looks a little different. But I would agree, generally speaking, that in terms of like the broader zeitgeist, like the normie brain, it's still very sort of off the radar. Like no one's talking about Bitcoin at 121.
I agree, but I think that that's like a good barometer for me is if you go to the grocery store, you go get your haircut and you ask somebody about Bitcoin, they'll generally say crypto. And then they'll also, when you tell them, what do you think the price is? And then they will go, holy shit. And that's the proxy of retail that will get everyone else to ape in, or like that analogy will like get the traditional advisors and people that are off the street that have never heard about Bitcoin. I think the demand that this was like pent up demand from people wanting to get exposure and their financial advisor. Because a lot of financial advisors historically have told their people like, look, don't go into it or wait for it to come on platform, or it's risky on these other ways. And so this was kind of like the demand that had existed previous that was also locked up in traditional like tax advantaged accounts or off like personal account. So it is retail, but it's a different kind of like net new marginal buyer. That is, I guess, what I'm referring to as like retail when we generally see all-time highs hit in these markets.
Yeah, no, that's totally fair. It's not necessarily like net new people who are learning about Bitcoin for the first time. It's more so other pools of capital that were trapped in various accounts that can now get exposure. But Liam, you had referenced the ETF flows. This is a pretty remarkable chart just showing IBIT and just clearly demonstrating these are the most successful financial products ever launched. IBIT alone is over 80 billion. I think the entire spot ETF, Bitcoin ETF complex is closer to 150 billion now. But Liam, any thoughts on what we're looking at here?
Yeah, I mean, two things. One, the unit bias is extremely real. Seeing 120 and so $1,000 on a Bitcoin seems completely out of reach. For most people, they don't even know that there are Satoshis, or you can buy a part of a Bitcoin, but they do see Bitcoin ETF, and so they'll just buy that. And then number two, to the FTX point earlier, that is certainly something that's real. They just think that all of the industry is primarily a scam for the most part if you're out from the outside looking in, and it does either end up in a landfill or that it just they just take your Bitcoin and run away with it. And so just having the name of Fidelity, BlackRock, etc. on your investment account is just going to drive significant flows. The options on IBIT, I think, are really underrated how much demand they've driven. And that chart is just like absolutely vertical. It's really like people are we're saying this is priced in. I don't know what to say to that. This is going to be a continued bid for a very long time. I think is just people continue to want more exposure, and it's increasingly available.
Yeah, it's an interesting thing you bring up about unibias, because I never thought about that in terms of like the ETF stuff and the flows, and it kind of further underpins. I was thinking about it the other day, like how do we put out a call like for like I wonder if there's like a bounty we can do of I was thinking about financial literacy and unit bias, right? Because we all know, and it's really sad, but like somebody can really pull themselves out of some deep stuff if they just realize if they stack 5, 10, whatever it is. And I was thinking about it because my wife just jokes around. She has a Cash App, and there's like significant money, and she hasn't put a lot of money there. She's just been doing it one off like for the past 5 years. And I was like, that actually is material for most Americans. And but there's no like financial literacy that's really tied into that from exchanges. So I'll make this short. Like there just needs to be, and I don't think it costs a lot. It can probably build off a lot of like the rails we've created, but it's just a SATS-based exchange, and then it just focuses on like financial literacy and like how you save and preserve wealth. Like nobody does that, and it's such a no-brainer. Anyway, so that ties into the
I was listening to Bill Gurley's pod over the weekend, and he was talking about, I guess, an initiative that he's been very close to is effectively trying to have all high schools, I guess, have some sort of financial literacy education. But I think there's a massive gap there still, because I think what he's talking about is like, how to use a checkbook, how to have like checking or savings account. It's like, well, no, you actually need to go a little bit deeper than that and like understand what money is to have like true financial literacy. So I think it's a noble effort, but I think there's still massive gaps in terms of how people perceive like what do people need to be learning about in terms of personal finances. It's like there's the first layer of just like how credit card debt could kill you, but then you take it a step further and like understand, well, how do you actually save in a form of money that can't be debased? And so I think there's still some additional learning that needs to go on there, but a noble effort nevertheless.
That was the pod that made me think of it. Like again, I was listening to the same thing. Sorry, Lou.
Yeah, I did as well, but it's completely disconnected, or like you can't teach that financial literacy, because people will naturally ask like, okay, well, I just made money, like why can't I just save it in dollars? And the answer is it goes down in value over time. And the natural answer is, you need to put that money to work into something else. And the reasons for that are essentially just speculating on, the S&P 500 will continue to go up over time through monetary debasement. And I think that's completely at odds with, public government education of financial literacy. And so I'm just like not very optimistic that will happen in a meaningful way. Unfortunately,
well, there was the other related initiative. I forget. I'm blanking on what they called it, but they were originally referring to it as like the Trump accounts. But it's like these saving accounts for all kids in America. They'll have access to at least a starting amount of like $1,000 that's put into the S&P. It's like, okay, that's a step in the right direction, but like you should have the option to put that in Bitcoin, not the S&P.
I think to Liam's point is this is like way off topic. If we got to figure out but like this is it's effectively like socialism, like which we're describing, and because it's making the case that we can't actually make the money and then give back and deliver better like we can than the government, because like what Brian's pointing to is whatever that Gerstner and Dell did is like, it's like when you're born, you get $1,000 and then it compounds and you get access to the equity market. It's like, that sounds good at face value until you realize, well, that's coming from somewhere. It's not free. Right. And then it's like, well, why am I giving it to you versus I'll figure out how to give it to you. And anyway, I'll bring it up later, because there's a deep rabbit hole I went into, like, the Great Depression, Roosevelt, and like all this stuff has just been this long game of socialism to mask kind of like the debt. And they make up these reasons like, oh, it's okay, it's a little debt for the kid, but then like there's all this other stuff. But going back to the ETF, the volatility and options, I think that's something that is been under discussed is the institutional capital and products that have come into this space will probably material dampen the volatility, and we've kind of seen that more like recently. And I think it's been pushed over to, it won't be forever. Like I do still think we'll see substantial volatility, but it won't be like what we historically saw with these headlines where Bitcoin would move in 10 to 20% in a day. We're seeing this in the like equity markets now with or specifically with the Bitcoin treasury markets where the volatility has moved over. And I thought that was just like an interesting aspect. Like this has been a pretty steady climb to 123. I've never seen it like this from, you call it beginning of last year to now. There hasn't really been wild moves outside of 5 to 10% over the course of a couple of weeks.
Yeah. Also worth sharing, we haven't made a new all-time high in gold terms, which I think is just worthy of pointing out. You can see there's sort of I'm not a TA guy by any means, but there is some resistance at these levels here in terms of Bitcoin expressed in gold. So something else to take note of as well. Where do we want to go from here, boys? We had a few things on the list to get to. Michael, maybe I was going to go to your tweet, but
let's do it. I don't even know what we put. We do these things, and then I love when they get to come back.
You wanted to share a tweet from yourself.
Oh, well, it's not really from me. I just post this stuff because we need it somewhere that's concise. So the quote is, allocation is an art. It's a beautiful, impressive thing, though unfortunately it is increasingly less applicable a term to what venture capitalists do. This was from Kyle Harrison, who I think is probably one of the best kind of writers, thought leaders in the traditional venture space. He's at Contrary Research. He's been in a number of venture firms before. They write really great memos. But he put out a piece this Sunday, and it was referencing that, again, allocation is a beautiful thing, but he refers to it as not what venture capitalists do. And at face value, you'd be like, well, that doesn't make sense because they're allocating capital. And then he kind of further goes to say, don't get me wrong, venture capitalists have capital. They allocate in that sense that they have it, and then they don't. But what makes allocation such a magical concept is the strategic implications of how the capital is allocated. And I think this is really kind of, maybe it sounds pedantic, but it's really fundamentally different than somebody just deploying dollars, because true allocation has to have the context of not only where the capital goes, but whether it's timing or synergy gets thrown around a lot, but how it compounds with others. And I think that people often forget how amazing allocators like Jeff Bezos and Mark Zuckerberg are, and Jeff Bezos in particular, because I think people don't know that he owned at one time like 5 to 7.5%. He was one of the earliest investors. I think he invested, it was sub 5 million. I think it was $5 million valuation into Google. And, but then post that he, then this writes here that in 2006, he did this pivot from taking the warehouse infrastructure and moving into AWS. And this was a big investment, and everyone looked at it, including Wall Street, like it was crazy. And then similarly, they look back at Zuckerberg and Instagram. And I just thought this was an important thing to call out, because it's one thing to allocate capital and try to go back into dollar terms. It's another thing when you kind of look at a business and an opportunity from the vantage point of where the market sits, the unique opportunity that we understand the money's changing. But then also as you're building businesses, you can kind of spot the angles on how compounding forces will occur that most people don't, because they're looking in almost like a 2D fashion of how do I like get my return profile versus a long game that these guys are ultimately playing long games. And it's no question the Jobs, the Zuckerbergs, the Bezos of the world are co-founder, like CEO. They're not people that were managers that got put into these positions, because they just can't help but only see the world in a certain like transactional view versus people like this.
No, it's super interesting. I mean, in that context, what do you make of Zuckerberg's latest sort of capital allocation decision to basically acqui-hire folks from OpenAI and other places for, hundreds of millions of dollars in salary? Is that a logical use of capital in this race that we've talked about the past few weeks in terms of just throwing piles of cash at AI in particular? Do you see a shift in his mindset in terms of like how he's thinking about allocating capital, if he's willing to do that?
It's a great question, because I think we're like in a transition phase, and I haven't heard this. I'd be curious your guys' thoughts. Like, there's a traditional sense in the fiat TradFi world that the dollar is your return. And then these guys are playing for something else that I don't know what it is. I don't know if it's IP, AGI, there's something else. And at the end of the day, they're all going to realize they're all playing for Bitcoin. And we're in a transition phase. And so like, they're not like thinking in dollar terms. I don't think they're thinking in dollar terms or in Bitcoin terms. They're thinking in like total addressable market, ownership stake in like global commerce. I don't think they're looking at this because these numbers keep changing. But if you had to like do a return on investment, I think that the total allocation, I saw it written somewhere that was like 1% of Facebook's total market cap for this bet to win AI. So it's pretty straight. That's like, that was the most straightforward that I saw. It's like, so it's 1% of his total business to win potentially AGI or win whatever they're competing for. It's pretty good, right? You know, ROI.
It's one aspect that I thought was interesting too is essentially there was somebody who was thinking about this a little bit differently and would be curious your guys' thoughts. Like, if essentially 1% of all venture investments drive all the returns, it's not that illogical to think about it from an employee standpoint of there are significant people who can make outsized contributions to a company and the direction of it. I do think that they need to have a massive stake in the vision of where things are going, like the Jobs, the Zuckerbergs, the Bezoses of the world. But I can understand from that perspective why they would be willing to pay that much money. I don't know. I don't have a strong view yet because I don't know what they're playing for, and I'm not that deep in the space, but it's interesting for sure.
The other interesting just about this tweet that we still have up, if you think about the Instagram acquisition, I think most would perceive as one of the greatest acquisitions of all time in terms of its IRR, 65% IRR over 13 years. I don't have the exact numbers in front of me, but I think Bitcoin's IRR over 13 years is probably closer to 100%. I know it's 65 around the past 5 years or so. So even one of the greatest acquisitions of all time would have underperformed just buying Bitcoin. Worth pointing out.
With that said, but I think that's where the allocation decision comes in, because you can make the case that Instagram delivered more enterprise value than that return. I guess if I read that, and that's revenue per year, but we don't know like the creative value. Like that's the thing with money is it's just money, so it's not. It gives you optionality if you didn't have any, but this would potentially be more in Bitcoin terms if they would have like spit out more capital to buy more Bitcoin.
Right.
Yeah.
Hey guys, thanks again for tuning into another episode of Final Settlement. We had an awesome pod talking about all the things happening in the current market landscape. Just this morning, I believe DCG filed for IPO, as well as the price, I think last night, top ticked close to $123,000. It's a very exciting time in the industry, and no better time to learn about multi-institution custody and everything that we're doing at Onramp. Folks may be interested, have heard of us, would encourage you to schedule some time or look at what we're building in the institutional, kind of private institutional across the board custody landscape. But if you're not ready and you just want to follow along closer, we just recently put out a really great report with the Bitcoin Policy Institute. We worked on it with them and had them on the podcast last week, Zach Shapiro and Zach Cohen, specifically talking about the Strategic Bitcoin Reserve Playbook, the toolkit for adoption for all states, including the United States, and multi-institution custody was a big component of it. We like and joke, if multi-institution custody is good enough for a sovereign, it should probably be good enough for a few individuals. And so we'd love to talk with you if you're interested. Schedule a time with us via our website. You can book a time directly on the webpage, or you can just sign up and go through our onboarding flow. All right, on to the rest of the show.
Next one on the list, Michael, I think this was one of yours, but VCs on which crypto companies could IPO next? Anything worth pulling out of here?
So I'll wrap two parts to this. So the first one is, this is a Block article referencing the crypto VCs. They were pontificating on what companies are going public next. It was funny because this came out, we were going to talk about it, and then it came out this morning that I believe DCG is going to be filing for an IPO. If you scroll down, I think it's talking about the multi-year, I think we paused right there. Yeah. If you go up. So I forget who it was quoted, but it was explaining basically we're in a multi-year kind of market for IPOs, which I think is true. I think it's going to be very fascinating to see what happens, just given what we see behind the scenes. I feel like this is an extended. Can you keep it there though? Because I wanted to go. Yep. We're an extended. It'll be interesting to see how far this market runs with Bitcoin, and then I think the market, as Bitcoin runs, everything else follows, including the amount of companies that'll be able to IPO. They reference OKX, Uphold, FalconX, Ledger, Chainalysis, Fireblocks, Consensus, and then DCG as another one. So I think it's going to be interesting. I think this extends not just to crypto. This is just a crypto piece, but I think in general, the amount of I think Circle is a great proxy for interest in this digital asset space. The thing that I think most of these firms are missing, and it's going to be very interesting, like we got to figure out a piece on this, but I'm confident the way people miss Bitcoin and they're still not woken up is going to be how these people like in this world missed underlying custody. Because right now everyone's talking about stablecoins. Everyone's trying to figure out their stablecoin game plan and the securitization. And they're all going to like net settle or end up trading. Like the real anchor pair is BTC. And then you want to get closer to that. And none of them are actually focused on underlying, like how do you get a position of the 21 million? And that's like the biggest asymmetry once you understand Bitcoin and if you're building infrastructure, and none of them care about it. And so that's another just like unique opportunity that we're really kind of focusing on right now.
I love that you brought that up because I have kind of two things that come from it. One, yeah, the first people who came through the door in these in the crypto space, they naturally got distracted with everything else. And so at the same time, I think there are new entrants that are coming in now. I think Bitcoin dominance is 65%. There's a lot of noise in the market, but you can tell by the Bitcoin ETFs versus everything else that Bitcoin is completely different than institutional demand for Ethereum, etc. And from a personal anecdotal side of things, like the retail interest isn't there. I'm not sure how many texts you guys get from friends and those who are just interested in Bitcoin, but it's probably not a lot. What I have seen is my friend who's VP at a private equity firm. He's looking for a new job, and he's like, okay, here's an investment firm that I applied to, but they have a corporate development role, and the corporate development role is just buying AI companies, and they're also going to implement a Bitcoin treasury strategy. And so he went out to me and was like trying to understand what is the arbitrage play that they're doing, and obviously happy to explain that to him. But I think some of what we've been talking about of the illiquidity of private equity investments and them staying private for longer will change as some of them, as we've seen with Figma, just buying Bitcoin and, keeping that as a small amount, as well as some of them going public. And I think there will be more than we anticipate, or more than most people anticipate, in terms of returns driven through portfolio companies of venture and private equity firms buying Bitcoin, as well as some going public because they have not given money back to investors yet. And so naturally, when you do that, the investors will ask the question of, well, why are you having the company buy Bitcoin? Like, why can't I just do it myself? And not especially because many of these publicly traded companies, their main KPI is just like, how much more Bitcoin am I getting over time? The LPs will naturally ask that same question, and that's kind of why. And then that will be something that the general partners have to naturally change as well. They're going to have to change their carry and hurdle rate to be higher than Bitcoin. Otherwise, people can just buy it themselves. And I just thought it was super interesting that the early riders thesis that we've started to talk about like a year ago is coming out to not just Bitcoin companies, but pretty much there are early signs that it's going to transition to the rest of the private equity and venture world as well.
Yeah, that's super fascinating. And something that I think we would all expect to see continue head that way, but it's interesting to see that sort of specific anecdote from someone in more of the traditional PE space, kind of realizing like, this is, obviously becoming potentially an overcrowded, saturated trade of just like, spinning out a public Bitcoin treasury company type deal. But I think you're going to, we might still be in the very early innings of it is really the takeaway. It could extend a lot farther than we think.
Well, every
Yeah,
company's going to buy Bitcoin too. I mean, the premium may or may not be saturated, but the owning Bitcoin itself is still very early in the trade for every company.
100%.
Yeah, I think the big question for me on the pubco stuff is if it ends up in a it's going to burn out. I can make any bet it'll burn out. It's just, does it burn out like with a bang, or does it like with a whimper? And what I mean by that is, does the market naturally de-lever because there's some kind of like understanding of somebody gets rugged with counterparty risk, or they all start to play a trade? Because this is what happened in 22 with everyone into 3AC, and that's what caused the systemic risk, problem. And so does it all just like de-lever at once? It probably ends up like that, because that's just how this industry works, is as quick as it goes up, it goes down. But the alternative way, and it's not to say they're mutually exclusive, but the alternative whimper is, what Liam's saying is like, it's just going to be understood that whether it's in bonds, whether it's in insurance, and specifically public equities and private equity, you just have to hold Bitcoin, and you just have to hold it, and they'll just make up all those BS reasons why. It'll be like AI, and you got to like preserve, and like they'll make all these reasons, but at the end of the day, they'll come around to like, oh, this is just like a savings account. And then you'll just have some premium on, we'll make up new numbers, like on whether it's DCF or multiples, like we'll just come up with new numbers on what the underlying business coupled with their Bitcoin treasury, and then how much Bitcoin they're creating. And then that'll be like what the equity market will absorb. But again, you can see how it goes that way. But between now and there's going to be a lot of education on who's actually delivering value and who's not.
Yeah, it's just going to be multiples on how much Bitcoin you can deliver per year. And if that is sustainable, or if you think it increases or decreases over time.
Yeah, and to Mike's point, like the big thing that nobody's even talking about is just counterparty risk. And like that probably, if there is some sort of deleveraging event, in my mind, it's probably related to that, where some custodian fails in some way, shape, or form. And then there's a recognition from everyone who's invested in these proxy exposures of, well, who's my underlying counterparty layers beneath the surface.
My bet is it's probably, it could be custodian. I think it ends up being just somebody gets on the risk curve. Like you can always know it's suspect if somebody doesn't want to show you their balance, if they're a public shareholder or they have shareholders, because that just inspires and invokes confidence, especially in a world where this does happen. And the reason why they don't is because they naturally are going to want to extend leverage and not want you to see, or have optionality for leverage. And so that optionality is ultimately going to end up in a rugging, because that's what happens. And that's exactly what's happened for 15 years, is when people are naked with the Bitcoin, you end up losing it all. And so that'll happen. And then that'll be when the people start waking up to like, where does the asset sit? And then we'll probably end up for a longer run, because then it'll be like, oh, they have it here, but then like who's auditing and where is it on chain? And then somebody else will rug, because they'll say it was there, but it wasn't there. And then we'll kind of end up into like a more transparent way. And we've all talked about the custody with what we do, so we don't have to probably go deep.
Well, slight transition. We had referenced some noise. Generally speaking, I would categorize this as some noise in the market, but Pump.Fun raised $500 million in a matter of minutes in a token sale. Any thoughts around it? We've sort of talked around this of like the broader crypto ex Bitcoin is sort of out of narratives, and it's either stable coins or literal casino gambling, a la Pump Fund type websites. And so, I think this is just an indicator that is the case. Outside of Bitcoin, stable coins, really the use case for all of these crypto networks is predominantly gambling. And as we've discussed, the sort of expected value on this form of gambling is actually worse than stepping foot in a casino. And so it is very representative of sort of broader financial nihilism, which we've spoken about, and people feeling like this is their only way out, their only way to accumulate some Bitcoin is to gamble on pumped up fun. Any thoughts on this?
I think it's all kind of gambling and nihilism. I kind of like the like the pump fund versus the treasury, just because it's so shady and like quick and fast. Like it's just like get in and get out. I think what's fascinating to talk about this is just how the market structure around venture capital in the digital asset space is kind of not transitioning, but like morphing. So you got like VCs that are going into these pipes, right? Because there's no real opportunity. So now like venture capitals are going into the pre-funding of these treasury companies to return. They're now called digital asset. They're called DATs, just in case anybody's curious if you're listening. So the digital asset treasury companies, because they're not, just to Bitcoin now. So you have, I think this past week, there was Solana, Ethereum, I guess Hyperliquid, another couple, but these will continue to grow. I think we'll see more of this, which we're describing with a pump, because I know we've had this discussion on like the dominance level with Bitcoin. And I think ultimately we'll see the dominance top out at whatever point that, actually I can't pick the point outside of we'll start to like see it flow into the crypto markets, start to speculate more outside of the traditional equity markets. And I don't know what that looks like, but you're going to see the transition of like, there'll be the Bitcoin equities and then the crypto equities. And then you'll see like different layer blockchains, and then they'll start to like absorb them into these, there'll be like a recursive loop. And then we'll start to see that transition. Where is it at right now? I see you pulling it up. What's the number?
This is X stablecoins, and it's around, looks like 76%. It was as high as close to 80 a couple weeks ago. So it's come down a little bit, but I remain bullish Bitcoin dominance. I think, I understand the arguments around these other treasury companies being spun up with other assets. I think they're de minimis in scale relative to what MSTR and others are doing. I also think, like, as we've talked about in the past, people are expressing their views in different ways, and it's not necessarily accruing to the native tokens, Ethereum, Solana. Ethereum is languishing at this point, and I think around like 3K, and the last time it was at 3K, Bitcoin was at half this price. So that is reflected in this sort of slow grind upward in terms of dominance. And in order for this to top out, as you're sort of alluding to, like, you would need a massive shift in terms of institutional appetite for Ethereum, effectively, which I just don't necessarily see on the horizon. You've got the Tom Lees of the world showing what they're doing in terms of trying to do an MSTR strategy with Ethereum. I just don't think that that's going to have the same appetite, because it's just what we've seen with the ETF flows. There's been almost no inflows to ETFs to date.
Yeah, one thing to say is I can see a world where that's right, like where there's a top 5 basket of crypto, and then it ends up playing into DATs or whatever, and then people are really, the volatility, like we talked about, ends up going into private and public equity businesses that are traded on, whether it's on the stock market or these other blockchains that are going to be trading. I still hold out that that's not the case, simply because I kind of want that to be true. I just don't think it'll be true, because if we all said it and we agreed, no retail is in, like, this is just smart money, then of course they're not in like this garbage. But if we are going to come back to a crypto bull market where everyone comes in and everyone's cab driver, Uber drivers, they're not going to understand any of this shit. That's been my case this whole time, is the price is going to rip. And then naturally people in the crypto market cycle into these other assets, other things get spun up, other memes get spun up in vibes. And then you naturally end up in that like reversion back to it. That's the case that I've made, and I still make, because retail's not here. If we were at like $550,000 and this thing was at the same place or moving up, then I'd like say, okay, but we just all admitted like nobody in retail's here. So why would they be buying?
Here's the counterpoint that I think is going to happen is if you're not one of those DATs, I guess, then no companies are going to buy like Ethereum or Solana or any of this stuff. Like, I think that the bid from privately held companies with no plans of going public, as well as just investment firms that want exposure to Bitcoin, is going to be larger than retail demand for altcoins because retail will gamble, but I think that the long sovereign private company bid and investment bid for Bitcoin is just like too big and larger than retail interest that will inevitably go into altcoins. And I think that's just kind of a maturation of the market today.
Yeah, that's it. Yeah, that's a good take.
I mean, that's kind of been my thinking is like, even if you do see that retail bid for altcoins, it's going to be just magnitude smaller than the pools of capital bidding Bitcoin going forward. Like, if we get to 500K per Bitcoin, like that is going to be in part due to a sovereign bid in my mind. And like, sovereigns are just not going to be bidding altcoins. So it's just totally different pools of capital, and the sort of magnitude and size of them. I think it'll be very difficult for the altcoin space to actually eat into Bitcoin dominance going forward.
Yeah, I think that it seems right. I just can't help but feel that the institutional capital, they will make up stories to sell. Like what was the recent stuff that JPM, I think it was JP Morgan did. It's like an internal ledger. Like, there's just going to be so many.
They came out with something either yesterday or the day before saying like something about bullish about Ethereum. So I hear that side of it. I just don't think enough capital is going to actually buy the story this time, because if you look at Ethereum, like, it's actually losing it sort of protocol wars to Solana or Hyperliquid. Like, it's not even the best bet if you're looking for a bet on those protocol networks. And because it's still the second biggest, like, that's where the big delta is, because in order for Bitcoin dominance to actually come down materially, like, it actually has to come from Ethereum, because if Ethereum's just losing ground, then you would need like massive adoption of Solana or one of these other networks to actually eat into dominance.
And if this ends up playing out, then my instincts would tell me that the capital that's all on the sidelines or supposed to be allocated to the space, it ends up merging where, like, crypto, because we agree like Ethereum, Solana, and some of these others aren't going to go away. There'll probably be others merged. You end up having them be baked into like equities, and that's what gets the volatility in trading. And so this is just going to turn into like this other thing of like, because you don't know, you're moving.
It's much easier to bet on Robinhood, Coinbase, or Circle than it is to like, I'm gonna pick which one of these protocols is going to win.
That makes a lot of sense. It's also very scary for a lot of people.
Hey everyone, hope you're enjoying the podcast. We had an exciting discussion talking about all things related to digital assets, Bitcoin, and market infrastructure and capital markets. It was an interesting conversation around the amount of hours worked per Bitcoin. It's a trend I think we'll increasingly see those metrics as discussed on the pod. It's something we've looked at very heavily as far as early riders and the way we look at the world when it comes to investing, building, and how do you effectively return more Bitcoin than Bitcoin invested. And that's a proxy for how do you return more value than time invested. And so if you're interested in learning about anything we're doing on the early rider side, we want to check out our research. I'd encourage you to go to earlyriders.com. We have no shortage of materials as well as newsletter that comes out every week. And we're consistently looking for entrepreneurs building in the space, as well as folks looking to get involved in other ways. So you can reach out at earlyriders.com. You can shoot me a note at michael@earlyriders.com as well. On to the rest of the show.
Yeah.
All right, switching gears a little bit. Michael, you shared this tweet from our boy Matt Pines. What is he talking about here?
Yeah, so Matt Pines retweeted, I don't know who Pippa Malmgren is, but whoever he was retweeting, she had tweeted about AI outsmarted 30 of the world's top mathematicians at a secret meeting. If you go back to the Pines tweet, in this long form article we can link to, It said the mathematicians who participated had assigned non-disclosure agreements requiring them to communicate solely via the messaging app Signal. Other forms of contact, such as traditional email, could potentially be scanned by an LLM and inadvertently train it, thereby contaminating the data set. And so Pines is effectively saying that he says exactly, there's an underappreciated near future dynamic is one where human surveillance state capitalism is replaced by AGI panopticon, where every packet is sniffed out by networks of autonomous LLMs hungry for every digital morsel, where the internet becomes a dark forest. And I thought this was important to call out because I think that we talk internally and externally a lot about the underlying asset as a store of value, but I think we all agree and know that the internet in its first version wasn't really built out and baked out correctly. We've seen the centralization of these large, behemoths like a Twitter or X or Facebook, among others. And there's a number of reasons why. And over time, there's going to be an encroachment on privacy. And we've seen this in other states or other countries specifically. We all know about China, but then even in the EU, it's increasingly becoming harder to, with the censorship, among other things. And this notion of privacy leveraging the Bitcoin protocol, I think, will naturally emerge. And so I just thought it was a fascinating thing. I don't think it really plays out until we get more, like things will get worse. And then also as things get worse, a lot of the people that built these existing worlds will also be adopting Bitcoin. And I think Jack is the perfect example of this. And that's what, Pines references is Jack, who recently put something out, which was like an encrypted chat. I don't even know exactly how it works, but maybe Brian, you've looked into it, could share.
Yeah, he's what Pines alludes to in that tweet is Jack came out, I guess, over the weekend with a messaging app called BitChat that doesn't need internet or cell service. It works over Bluetooth networks. And so this is sort of along those lines of, broadening and thinking through ways of enhancing peer-to-peer networks that don't necessarily rely on centralized servers. So this I thought was pretty interesting, and basically allows people to communicate via Bluetooth networks. Now there's some obvious constraints around that, like you need to be near people, but the overarching idea is that similar to sort of how the Lightning Network works, you could have basically hops that allow you to spread out this sort of mesh network of Bluetooths and any phones that are connected to it. And so sort of just interesting along similar lines of as this digital panopticon and the perhaps perverse incentives of AI start to take hold, there's going to be sort of a work that needs to be done counter to that to preserve people's privacy and preserve decentralized networks that work in peer-to-peer fashion. And so this is, I think, a step in that direction, but expect to see more things like this as sort of those risks materialize. All right, let's see what else we got on the list here. This was an interesting chart worth sharing, sort of, similar to the previous, what we were talking about earlier in the conversation. Just hours of work to buy one Bitcoin is ripping. And this is, really indicative of just wages, not keeping up with inflation, generally speaking. And just that will make it harder and harder for people to accumulate one Bitcoin based on what they're earning in fiat terms. Any thoughts on this?
Yeah, this one stood out. I think there was two reasons. The first one was I think the version you hit on, which is just the measurement of amount of output for one Bitcoin. So we've talked about it, which is the measurement amount of investment into early riders versus amount of Bitcoin return. That just makes sense, right? How much Bitcoin can I get if I put my Bitcoin at risk? Amount of time of your personal time at risk, amount of number of employees to make one of those Bitcoin, right? There's a lot of versions that I think that will just grow over time. The other one that is a little bit more of I don't want to say meta or abstract, is this notion of as it starts to increase the number of hours, there's going to be a natural push pull between hours of Bitcoin to work, and it'll go up, and then it's going to go down, and it's going to go up. And that's how the world gets more efficient. Because what's going to happen is people are inefficient today. This is a product of too many dollars. And this, again, it sounds like theoretical until you kind of are inside an organization building it and you kind of think through, okay, how can one person produce more and how can they do the work of 10? And then they naturally would take less number of hours to produce that Bitcoin. So the idea is today it takes a number of hours to produce that Bitcoin because the price is rising and they're inefficient. And they'll try to get that Bitcoin at reduced work. So they'll be higher, more efficient to produce the same amount of output. And then that'll like start to drift because now you're basically becoming more efficient as the price is going up. So it commands more hours. And that's just basically like this edging all the way out into how we end up like in a different universe, if that makes sense.
It does. It does. I think what you're sort of describing is that this chart at current is not reflecting necessarily the go forward efficiency of a single person and their ability to leverage deflationary tools in order to, buy one Bitcoin faster than they currently can today. And so, yeah, to your point, this will be a very interesting chart to monitor going forward, because I think if you see dips in this chart, it's not necessarily that Bitcoin price is going down. It's that we're all overall becoming more efficient as workers, doing more with less, et cetera.
Yeah, and then which causes more, you're doing more with less, and then it gets harder to buy the Bitcoin because the Bitcoin's price is rising because it can purchase more. And this is the whole beauty of a finite supply. It's a really like heady thing to think about, but that's what I really thought of when I see this, is because it won't always go up and to the right like this. It will until, yeah, it's one we got to like work on, because I could see like in dollar terms, it'll go up and to the right, but then eventually it'll be like a different metric. Or maybe it'll always be hours, because hours are hours. But anyway.
Yeah, very interesting. One more deal that I thought was worth referencing was CoreWeave to buy Core Scientific, the Bitcoin miner. This was a deal that was initially proposed last year, actually, I think for a valuation around $1 billion. That got rejected. They're now buying Core for around $9 billion, I believe. And I found this interesting just from the perspective of, I think there was a lot of talk around basically miners on both, on the Bitcoin side, diversifying to service various forms of AI compute. And this is sort of that, but in the other direction. So an AI focused company acquiring the infrastructure of a Bitcoin miner. This is also interesting because Core Scientific went bankrupt, then restructured. I think they emerged from that restructuring in the beginning of 2024. And that's when they sort of started their own internal pivot more to the AI side of things. And so you could see that as sort of, the initial stages of moving towards this type of deal where they would just get acquired by an AI company. And so that is now occurring. I think the other takeaway from this to me is sort of just points to the ruthless competitive nature of Bitcoin mining space, where I think you're going to start to see less super large Bitcoin mining companies like Core was, and basically see over time Bitcoin mining pushed to smaller scale operations, more on the edges, and part of that is also just from the competitive perspective of the largest variable in Bitcoin mining being your energy cost. And as nation states get more involved in Bitcoin mining, they will, in all likelihood, have access to energy sources which are zero cost to them. And so that just makes it harder for a public miner, whether in the U.S. or otherwise, to compete if they are have some amount of cost relative to their infrastructure, to their electricity costs, I should say. And so I think all in all could be a positive sort of trajectory in terms of the decentralization of mining, not having it as concentrated with these super large sort of mega farms. Any thoughts on this deal or sort of how the mining space is evolving?
Yeah, I completely agree with it will decentralize over time. I think this is this is kind of a Trojan horse for all these AI companies starting to learn about Bitcoin and the importance of it as a strategic treasury asset. Because naturally, if you buy a Bitcoin miner, they derive all of their revenues in Bitcoin. So they have to make a conscious decision. Do I sell my Bitcoin or do I keep it in Bitcoin? And they will naturally do the analysis as part of the due diligence of has that Bitcoin gone up over time and performed better than cash, or like how do we think about selling Bitcoin as a treasury asset in order to cover expenses, because their expenses are still dollar denominated. And once they do that analysis, they're going to realize that over a long period of time, holding the Bitcoin is better than selling it for dollars, especially if you don't have expenses that you need to pay right away. And I think this is one of the Trojan horse ways in that the AI industry understands that having Bitcoin is very important as a corporate.
Yeah. I don't have much else to add other than I think it's going to be extremely fascinating, the confluence of sovereigns, AI, data centers, and then Bitcoin, and how they just naturally integrate together. Because to your point, like, it makes zero sense for any AI data center company to not have any like R&D or understanding of how Bitcoin mining works, because it's pure optionality if you need to basically like move over for whatever reason, whether the Bitcoin price rises to a point where it makes it economical to switch that, to giving you opportunity, to just even negotiating. And that's just one aspect. That's like not even talking about the intersection between AI and Bitcoin. A few things before jumping is just like a crypto corner over here that I thought was interesting. And this relates to Bitcoin. That I guess this is Crypto Week. So there's supposedly the Genius Act, Clarity Act, and then the anti-CBDC. And my understanding, cursory understanding, is Genius looks good, which is a stablecoin bill. Clarity, which is more market structure, is probably not anywhere near on the table to be done. And then the anti-CBDC, I don't actually know. And then the other thing was related to, I don't know his exact, I gotta look it up, but his name's Jonathan, I want to say Gold maybe, but he's the new OCC, head of the OCC. He was a proponent, put together a piece about halting choke point 2.0, and then he was actually the last person, I forgot what his role was previously at the OCC, that approved Anchorage for the banking side. And I think those are all super just fascinating when you think about the growth and maturation of the industry, because you've seen, BitGo, Coinbase, and maybe one other circle looking for bank charters. I think we're going to naturally start to see this convergence between digital asset firms and bank trust, and what does it look like to hold deposits, lend against them. And this kind of like, it goes under the underlying thesis of we just like end up in an extended bull market into probably like late next year, if not even further, because there's just a lot of things getting executed and delivered to the market that still aren't priced in, or the flows haven't been brought in yet. And there's not much leverage is the last piece. Like, I don't think we've seen a lot. There's not much leverage in the system yet.
Yeah. So you're saying super cycle is...
No.
I think that there's probably a lot of leverage outside of the system on the Bitcoin treasury companies, et cetera.
Possible.
Not even that the Bitcoin treasury companies are too leveraged. It's the people that are buying shares of the Bitcoin treasury company are too leveraged.
Yeah, I mean, there's that, and there's definitely a lot of, do your own diligence. There's a lot of treasury companies that have Bitcoin that's not their Bitcoin. They have some 33 different levels of Bitcoin lent to them and how it's structured. Even private companies that say they have a bunch of Bitcoin that's not their Bitcoin. So that's a component, but it's what we call a healthy leverage right now.
Intelligent? Is it intelligent leverage is the real question. But no, I'm glad you brought up Crypto Week. That is another thing that people are pointing to around like what's driving price, just general bullishness, optimism around Crypto Week in DC. I think there's also should be some form of a report that's due at the end of the week. So maybe we get an audit. Maybe we get an audit of how many Bitcoin the United States government owns. I'll believe it when I see it on that front. But I think that was part of the original sort of timeline end of July-ish, we would get some sort of reporting. So we'll see.
On that, there's a fantastic book that Prince recommended. There was two, but the one that I started reading was The Secrets of the Federal Reserve, and super fascinating. Like the way that it was written, researched, and the guy that like wrote it was like locked up in a ward, and he was like a guy that helped Ernest Hemingway and like all these people write. It's a very like interesting. It's all research, but the point being is they break down how crazy for since like the Jekyll Island meeting to the enaction of it in 1913. And it made me feel very crazy, or like not crazy, but like even sitting here, because I usually don't jump into the conversation about Musk and the what is it called, the debt, Doge and all of it, because it just didn't feel like earnest. It feels like WWE or wrestling. And I feel very vindicated. Like I encourage you guys to read it, because the amount of like manipulation of how they like took out at the time, I forgot who the president was, and they inserted, I believe it was Woodrow Wilson, who came out of nowhere, and like Roosevelt came in for a bit just to steal the votes, and then both bills were basically the same but called different names, and then how they just like moved it, and then they did it on Christmas. There's a lot of these things that you hear about. They did it literally on the Christmas week. They were all supposed to go home, and they like rushed it past. And it just reminded me, like, they were doing this thing 100 years ago. And it also really ties into the capital, because when you go how deep, like owning the ultimately the cost of capital, I think we kind of joke around and like we talk about interest rates and all this stuff, but it's like we would laugh if somebody said you're going to put a price on bananas or the laptop, like versus the free market deciding. And that's effectively what's happening with money. And when you do that, you basically can control the world. And if you understand the amount of time it went through, then it kind of makes zero sense that it'd just be fine with it going to Bitcoin. And then that's when you start to go into the Pubco stuff, because you're like, well, there's obviously something afoot. So anyway, there's your weekly book reading, Secrets of the Federal Reserve. It's really fascinating, but it's also just kind of it's just crazy because it's all like out there, but nobody ever looked in. And then we won't say anything, but you know, the Titanic happened previous to 1913, and that was always something that was floated around, and they kind of like break it down in that book.
We will
new financial literacy.
We'll link it in the show notes, and maybe we have a final settlement book club. I think we should all read this one and bring back thoughts for the audience.
We should get
Prince in the financial literacy course too. Yeah, that they teach in schools.
You can just give him a Thomas Sowell book for that. I don't think. What's his good one? There's like a very basic. It's like Basics of Economics. Have you ever? Or I know that's Henry Hazlitt. That's a good book. We should recommend. It's like the window theory right off the bat is like an economist will say a window productivity. If you break the window and fix it, it's like, well, let's get back to the basics here. There's nothing. Anyway.
All right, boys. That's a good place to wrap it. Thanks for joining us. We'll see you next week.
Thanks.
It all comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a giga-transaction.
The internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.